Hi everybody, Brian here from quantlabs.net. We have some interesting things on the overall ranking of what to trade based upon the data using daily charts that I've been analyzing. Now, if you've hopefully been watching over the last couple of weeks on the videos that are important for this, that will lead us to where we are. It's a combination of updating statistical view on many forex pairs. These are the video titles on my channel, youtube.com/quantlabs. That's the name of the channel. So we're using a statistical view. Also, if you're interested, we also have a view using technical analysis. All the data has been generated on February 21st using 500 data points. And this technical analysis includes Fibonacci retracement, moving averages with a combination of a 20, 50, and an EMA of 50, with on top of something else. But it's between this technical analysis, the moving average. So the title of the videos, if you're interested, are New Technical Analysis on Many Forex Pairs for February 21st. That's the first video to look at. The second video to look at, I'll help you out, is New Moving Average Technical Analysis on Many Forex Pairs. Then you want to take a look at the statistical view on a video called Updated Statistical View on Many Forex Pairs. And that's the statistical view. So now what we've done is we've combined them all and we've come up with this overall ranking using part of the technicals is trend. Again, we're only using daily charts. We don't care about intraday right now. We're also looking at the crosses of the 200 versus 50-day, as well as the positive returns that we've generated through the statistical view. Again, these are only rankings or metrics we're using to get this overall result. So remember, these two on the green and red, which is trying to be the support and resistance overall, support and resistance trend lines of these periods, is the gradient of the slope. The lower it is, the better the trend is overall. And then we also combine that with, as I said, the moving average long with the 200 crossing over the 50. I could also throw in the moving average short as well, which is basically measuring when the 50 crosses the 20, if I want. And then the positive as well, on the positive returns, number of returns versus over 500 that are more positive. As a result, this is what's generated in this order because I've already ranked it based upon this score. Doesn't really matter. Now, a couple of things that what we've done is these two are probably the best performers over the last 500 days. There's one in here, the New Zealand dollar is a poor performer. We've confirmed that, and that's just due to there's not enough trend there, maybe even downtrend for all I know. But these two seem to be doing okay. So what I've done is, if you go into my YouTube channel once again, and you can easily do a search on portfolio optimization to see how this works, there's a bunch of videos in there that will guide you through the process I'm about to show you. So essentially what I've done is I've got a script that will analyze the currency pairs based upon the historical data that I have of the 500 days. Gives me the ranking, as I said, Euro, Norwegian kroner, and the British pound USD were the two best. And I also combine that with a New Zealand and USD as a poor performer. And I've done a number of combination of analytical comparisons. I compared the Euro, Norwegian kroner with the British pound USD as one combination for portfolio allocation. So meaning if I'm going to go out and deploy, let's say $500, $1,000. This report will give me how much percent I should allocate for the British pound USD and how much I should allocate percent-wise on the USD Norwegian kroner. So what you'll find is for best performance, it says to put, Euro Norwegian kroner and the British pound USD as the top two best performers. So out of that, you'll get an allocation of the weighting on how much I should allocate out of, let's say, $500 or $1,000 of capital for the day, for the trading session, on how much I should deploy to, let's say, the Euro Norwegian kroner and the British USD. And that's all driven by doing different types of analysis on the portfolio using different types of portfolio techniques. There's 5 of them. I'll show you that in a minute. And we do a detailed analysis. So we do a combination of these two pairs against something else. Now, typically, when I go live, I'm only going to go long only, but I'm curious to see if I was to combine these two, or the Euro Norwegian kroner up against the New Zealand dollar USD, being that this would be my ultimate long, and this should give me a better performance on the short. What I found was, and I've seen this various testing, that's not the case. You will learn after however long this video is that these are the two best. That's the spoiler right there. The top two best will always be your best performers. Now I go into details on comparing it, but I also did a comparison on how did these 3 pairs combined perform against these two. And again, these two highlighted perform better. I also did a comparison between the Euro Norwegian kroner and the British USD as a combination pair against, just assuming I just want to go in all in on the Euro Norwegian kroner. Once again, the combination of these two, Euro Norwegian kroner and the British pound USD, outperformed that. Lastly, I did another comparison of the Euro Norwegian kroner with the British pound and USD, comparing against this alone. What won? This one again. And the performance is quite stark. Even the next best, this combination still outperformed it quite a bit. And that means if you did that each and every day, you'll be able to grow your portfolio overall faster if these expected rate of return exactly play out as you would expect. So what type of analysis are we looking at? Again, I'll go over this. I'll probably bludgeon you to death over this. But essentially what we're doing is, let me just get to a sample here of one of them. So we are dealing with this one right here, and with each comparison for analysis, we're just comparing, again, the expected rate of return against these 5 types of portfolio strategy types. So we have minimum variance portfolio, long only, minimum variance portfolio, long short, and then we start playing. Okay, so coming back to realistically what I'll end up doing. For now, all I'm going to really do is just do long only. I find that I get killed just for whatever reason when I combine the short. But usually when you add in a short, you do better. But in this case, you'll see that there are no shorts. So it's really long and only. But there are going to be times where I may have better performance with a short. But again, it's, as the keyword says, expected. So once again, we are dealing with minimum variance portfolio, long only. That's probably what I'll only do. Minimum variance portfolio, long short. Now, using Markowitz, it's a different analytical technique. I'll let you Google it. But the Markowitz portfolio long only, Markowitz portfolio long short. And then there's also another one called Markowitz portfolio market neutral. Okay, so it's kind of like adds up to a zero-sum game. As I said, this one or this one, Markowitz portfolio long only or Markowitz portfolio long short, usually are the better outperformers. And you'll notice on the minimum variance, the weight allocation is slightly different. So for instance, on our best performers of the Euro Norwegian kroner, using Markowitz portfolio, no matter what it is, it says here just allocate 30%, and then the British pound USD as 70% for both long and long short using the Markowitz portfolio technique. When you compare these 0.3, 0.7, it's a little more granular on the level of percent. So if you were to take, let's say, $1,000 and then allocate exactly this 0.6768% for the Euro Norwegian kroner, for instance, along with the British pound USD at 32.31%, you'll get slightly lower expected rate of return. If you were to stick with a Markowitz, you get a bit more mileage. Okay, so that's kind of like the summary of what I'm about to show you in these videos. Hopefully you'll hang out in there and learn some more on what can be taken from this. Over and out. Hi all, Brian here. I just wanted to go over with you some testing on portfolio optimization. My system now has the ability to measure best currency pairs, and just wanted to show you something that's very important. These are the ranking according to a previous script that I haven't shown yet on video, but there's 12 or 13 pairs here as sampling, and the best one for best expected returns is the Euro Norwegian kroner, and then the lowest one would be the US New Zealand US dollar. So these are the results of the ranking. So these are the best. So what I thought I'd do is to show you, actually, two things I want to show you. This is my portfolio optimization. It's taking the two best, which are Euro, Norwegian, kroner, and British pound and US dollar. There's another one, if I can show you, give me a second. We know that one. And then we also have another one comparing Euro, Norwegian kroner, the best, and the lowest of the New Zealand US dollar, as I just showed. So we're basically showing the rankings here on the left for the portfolio optimization on the expected return. And we're also doing a comparison of the Euro Norwegian kroner against the worst. The logic here is depending upon your strategy type. So for instance here on the left, and it's the same with this one on the right, is we are going to have four types of analysis done. One on long only, one on long short, and then another combination of long only using Markowitz and long short using Markowitz. So it's four combinations on this type of analysis. Let me repeat. We have one for long only using minimum variance, short and long, and then Markowitz long only and Markowitz short and long. So we're going to be doing two comparisons. Once again, on the left, we're doing the two best, which is the Euro Norwegian kroner, as well as the British pound and US dollar. And on the right, we are going to do an analysis with the Euro Norwegian kroner against the worst, New Zealand US dollar. Now, the reason I'm doing this is, in this scenario, is if we do a long and a short, we would expect to get best returns on the long if it's long only, And if we use long and short, we also combine that with the worst but best return potential for the shorting end, which is this one because it's the lowest one for the shorting as a shorting opportunity. Okay, so let's take a look at the comparison between the two. Now, again, we're using Euro, Norwegian kroner, and British pound with the US dollar on this. You can see here, I'm going to stop here on the minimum variance. And again, on the right here, we're using Euro, Norwegian kroner against the worst, which is supposed to have the best potential for shorting, the New Zealand and US dollar. So here's where we stop. Right here on the left, on the Euro, Norwegian kroner against or combined with the British pound and US dollar. If we look at these two analysis types using minimum variance for long only and minimum variance for long short, what we get here is a pretty small pittance in returns. Actually, it's better than this one by a long shot. So here we get 1.8% expected return on the long only, giving us a Sharpe ratio of 6.8, as well as if these remain in a low volatile environment of 11.4%. Now, when you take that with the minimum variance portfolio, with the long and short, you will notice here it's pretty well the same, a 1.8 for the expected return, as well as a 2 point, for the expected Sharpe actually is higher with 11.4, and expected Sortino is the same. But again, there's no allocation on the Norwegian kroner and the US dollar, so this would stay long. Now, if you take the same analysis comparison against the Euro Norwegian kroner with the New Zealand USD, you'll know that when you compare the long only minimum variance portfolio, long only, the expected return is 1.1%, whereas here on the other one it's 1.8. Our Sharpe ratio is 4.9%. Sortino in a low volatile environment is 7.6%. Now, if we combine that for, again, the Euro Norwegian kroner against the New Zealand USD in a minimum variance portfolio, long and short, our expected return is 1.18%, whereas I compare that against the expected ratio return is 1.8%. So again, the other one of Euro Norwegian kroner, again with the British pound and USD, is quite a bit higher. I won't say double, but it's quite a bit higher. And again, the rate, the expected Sharpe is 7.6, and that's long and short. The Sharpe ratio for the minimum variance portfolio, long short, with the Euro Norwegian kroner with the British pound USD is long only would be 11.4, so it's significantly higher. Now let's compare the Markowitz. So again, the Markowitz combination here, of all of them, are still longing. There's no shorting here at all. It looks like there is on the neutral, market neutral, but we'll get to that in a minute. So when we look at the Euro Norwegian kroner combined with the British pound USD, Markowitz long only, expected ratio now gets a little better, 2.1%, Sharpe 11%, Sortino 11%. So let's compare that to the Euro Norwegian kroner against the weaker New Zealand dollar USD, against the Markowitz long only. We have here 1.2% expected return, and that's compared against the 2.1%. So again, Markowitz portfolio long only is better than the combination of Euro Norwegian kroner with New Zealand US dollar. So that combination is much better. As you can see here, the Sharpe is 7.6 up against 11. No comparison there. Okay, so let's combine the long short. All right, so again, with the Euro Norwegian kroner combined with the British pound, US dollar, we are doing Markowitz portfolio long short. We have 2.2% expected return, Sharpe 11, expected Sortino 11. Now, when we take the Markowitz portfolio long short up against the Euro Norwegian kroner, New Zealand US dollar, in the Markowitz portfolio long and short, our expected return is 1.2%, which doesn't compare against the previous. Expected Sharpe 7.9% or 7.9. Expected Sharpe 11 with the other. Sortino 7.9 up against 11.02. Okay, so there is one last portfolio type, Markowitz portfolio, market neutral. How are we doing with the Euro Norwegian kroner up against the British pound, US dollar? What we have here Hello, welcome. What we've done in the previous video segment is, again, let me repeat, even though I know this is confusing, is what we've done is we did an analysis between the expected rate of return with the Sortino and Sharpe ratio on what we could expect. So we combine as if we were to allocate capital for the next session, trading session of, if we were just to deploy capital for the euro, Norwegian kroner, with the British pound and USD, and we did that combination to see how it performed with the best performing, which is what we'd expect, euro, Norwegian kroner, against, combined with the New Zealand USD. We clearly showed that the best combination between those two would have been the euro, Norwegian kroner, and the British pound USD. So now we've changed the analysis comparison. Instead of what I just said, what we're doing is going to do a combination of the euro, Norwegian kroner with the British pound USD. So there's only two currency pairs, but we've added on the right, we've added a third one, the third best, which is the USD Norwegian kroner. These are your comparisons. So once again, what we're doing here is we are comparing the best two expecting pairs. That is the euro, Norwegian kroner, and the British pound. Now we're doing another combination with a third best performer, which is the USD, Norwegian kroner. So hopefully you can see that. So again, we have 5 different types of analysis types, and let me just go over them. Minimum variance portfolio, long only. Minimum variance portfolio, long, short. Markowitz portfolio, long only. Markowitz portfolio, long and short. And Markowitz portfolio, market neutral. So I'm just going to go in and try to find the best performers of the bunch. So here we expect 1.8 on the long only. Now this is the first combination of the euro, Norwegian kroner with the British pound USD. Minimum variance portfolio is 1.8% expected return. Minimum variance portfolio, long short, 1.8. Markowitz portfolio, long only, 2.2%. Markowitz portfolio, long short, 2.2%. And expected return for Markowitz portfolio, market neutral, 2.2. This is the one I'd go with. Realistically, when I do my live trading, I will most likely go with long only. So we have here Markowitz portfolio, long, short, should be fine. So let's check it out when we add a third pair of the USD Norwegian kroner. Now, if you compare between the two, apples to apples, you'll see that adding a third on the long only, a third pair, hang on here, minimum variance long only is 1.8% on the two pairs, whereas if we did a comparison on the 3 pairs, our expected return is only 1.28%. Our Sharpe's radically, well, not radically, but it's dropped a little bit. When you combine the long and short on minimum variance, expected rate of return is 1.8, and on the long short with the 3 pairs, we're at 1.2. So you can clearly see that only having 2 pairs will retain a much higher expected rate of return. So if we now look at the Markowitz with 2 pairs only, our expected rate of return is 2.2%. On our 3 pairs that we've got, it's only at 1 point. Oh, sorry, we're doing Markowitz long only. So once again, Markowitz portfolio long only on the 2 pairs is 2.2%. As compared to the 3 pairs is 1.88%. Boom. Hopefully you're starting to see a trend here. Markowitz portfolio long only, 2.1% on the 2 pairs. And that's on the long short. Long short again for the 3 pairs is 1.8% compared to the 2.2%. So you can see here, only having 2 pairs is going to give you a much higher, not saying much higher, but will give you quite a bit higher expected rate of return. Now, once we go market neutral, for the two pairs, we have now a long and a short. So we short the 2.1, sorry, the British pound. I find this kind of wonky. Market neutral, it gives us 1.8% on the three pair. So again, moral of the story is if you do Markowitz long short or Markowitz long only, with these weightings, you should give you a much higher, well, I'm saying not much higher, but it will give you a few percent more. Whereas, Markowitz portfolio long only for both, again, the three pair right here, with this weighting on the allocation, you only get 1.8%. Whereas a Markowitz portfolio long only with two pairs will give you slightly higher, 2.1%. Now, I'm going to try to do a comparison with just one pair and see what happens. All right, buddy. One last analysis here. These are pretty well standard across the board. Doesn't matter on the combination of performance of the currency pairs, but what I'm finding is quite interesting. So here we are with a Euro, Norwegian kroner, British pound USD, and we're comparing against just only one pair being the best one, Euro, Norwegian kroner, okay? So we're just only allocating all our money for the best performing pair. Check this out. So you can clearly see here our expected return with the two pairs is a little bit higher. Actually, it's pretty close to 0.25% higher than the long only. Now, we can't do any Markowitz, so we can only do minimum variance portfolio analysis. So I think it needs two to do Markowitz, but we can do minimum variance. But when you factor in the minimum variance on the long or the long short, it don't matter because you still get 0.25%, 25% more higher expected return versus just the one pair. Thought I'd just put that out for you, and I do usually see this all the time. Okay, I'll talk to you later. One last comparison. What we're going to do is combine what we've been using for the last two pairs up against the standalone worst performing pair for shorting potential. Let's see what happens, and that's the New Zealand USD. So let's do analysis here. We already know the combination of the Euro Norwegian kroner with the British pound USD. So now we're just going to compare that against the poor performing New Zealand dollar USD. So again, you can see how abysmal of the returns you would expect, where you get 1.8, and all you would get is 1/3 of that, not even 0.06, and same with the minimum as well, or sorry, the long short. Doesn't matter what it is, it's very poor. I think the reason is I haven't really talked a lot about the volatility, but I bet you the volatility on this pair has been very low for the last while. That's why it's been kind of not performing as well. Whereas this combination is without a doubt the winner of the set that I have out of the data samples. So possibly the Markowitz is the better one. Right now, the long, short, long only doesn't really, from what I'm seeing, doesn't really matter. But what really is the optimal weights that you want to pay attention to? But again, this is only expected. So the markets could go crazy on the short term and throw this off. But this is comparative to the historical data over all the same time period for all of these pairs, regardless of how you look at it. Over and out. Hopefully this will help you out.